And hello, my colleagues, and I hope everyone is well at 5:32 in the morning and on December 31st. What I want to talk about is after I take my sip of coffee, sorry about that, is this example here where we left off 11.3. And I want to show you what happens with taxable considerations. All right, so the old asset purchased 2 years ago for 100,000. It has a current book value of 48,000. That means it's being depreciated. Okay, it's being depreciated, so it already was depreciated by 52,000. What will happen if the firm now decides to sell the asset and replace it? The tax consequences depends on the sale price, and this is a very important consideration. So this figure right here depicts the taxable income resulting from four possible sale prices in light of the asset's initial purchase price of 100,000 and its current book value of 48,000. The tax consequences of each of these sale prices are basically described in the following paragraphs. But here's what you can see. Here's the initial purchase price, and I'll just go through this. Here's the initial purchase price, right? Now, let us assume you sold it for 110,000, which is a little odd. You see that here, right? But it could happen, right? Somebody may really wanted it, but here's the current book value. Okay. Now, if this is the book value and you sold it for 100,000, 10,000, sorry, 110,000, you have the recaptured depreciation. You can't have your cake and eat it too, right? You got to pay taxes on the recaptured depreciation that you've been writing off all these years, and the fact that you purchased it for more than the initial 100,000 by $10,000 here. You have a capital gain, so you got to pay the capital gain tax. Okay, because so it shows you here from selling it at 110, you've got a total gain of 62,000 off of your book value. All right. Now, if you sold it for 70,000, which they show here, you don't have capital gains, but you have a gain of 22,000 in recaptured depreciation. Okay. And if you sell it at the book value, there's no gain or loss, right? And if you sell it at 30,000, you got a loss of 18,000, which you would write off on your taxes. And you know, so these are the tax consequences. And they go through that here in words, which I just kind of, in text, which I just did in words. So, so they're assuming the different tax rates, and they're showing you how much you would pay in taxes here. Like 21%. I don't know if that's the corporate income tax rate, right? So they show you all that. And here's if you sell it for less than its book value. The firm may use the loss to offset ordinary operating income, which saves the firm $3,780 by taking the corporate income tax rate times 18,000 in losses that you took. Okay. All right. So let's go through this little video here, and this will actually really nail it home. Oh, we went through this one. I'm sorry. Yeah, we went through this one already, right? I believe we did this one already. I jumped ahead the last time. All right, so that's that. All right, so change in net working capital. So let's talk about net working capital a little bit. And that's the difference between the firm's current assets and its current liabilities. So if I subtract current liabilities from current assets, changes in net working capital often accompany capital budgeting decisions. Right? So if a firm acquires new machinery and to expand its production, it will experience an increase in levels of cash, accounts receivable, inventories, accounts payable, and expense accruals, right? So this is all the things that would go up, right? These increases result from the need for more cash to support expanded operations, more accounts receivable, and inventories to support increased sales, and more accounts payable and expense accruals to support increased outlays made to meet expanded product demand. As noted in Chapter 4, increases in cash accounts receivable, and inventories are outflows of cash, whereas increases in accounts payable and expense accruals are inflows. Right. So increases in accounts payable are inflow, right? Because this is money you have that you have to pay out, but you're holding it, right? So the fact that you still have it, so you got to be careful how the definition is of inflow and outflow. Okay. All right. So there's a little matter of fact here that you can read. All right. So then the other term is so here's networking capital. This is this is networking capital, and then there's the change in networking capital, which is the difference between a change in current assets and a change in current liabilities. All right. So you can see that there, and just read up what the difference is between the change. All it is the delta. Okay. So that's just the change in that. All right, and I'm going to keep this one short, and then when we come back the next time, I'll pick it up on this example right here. Have a good New Year, everybody.